Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're looking to see if it's time to consider buying some tech giants as the Nasdaq enters a new bull market. Today we're looking at stocks that some people, one of them at least, might not be considered a straight up technology stock, but we're going to talk about it anyways. And the three stocks we're looking at today are Adobe, Mastercard, and Microsoft, which are three of the larger holdings in actually an S&P 500 tracking tech ETF. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we dive into the three stocks we're going to talk about today, it's worth just considering what's going on and why the market's kind of ripped higher this week and off those mid-June lows. So July's 8.5% consumer price index figure, so that CPI figure, did come in below June's 9.1 annual climb. Yet based on this pretty impressive response, which saw the Nasdaq soar nearly 3% on Wednesday after release, Wall Street appears to be pricing in the continued decline in oil and gas, as well as significantly lower consumer spending that would be needed to bring down inflation. There are, of course, far too many interconnected factors to say inflation has really finally peaked, and perhaps Wall Street's really starting to bet that a rather solid economic slowdown is coming, which would allow the Fed to take its foot off the gas and not have to lift interest rates much higher. That said, we saw that strong July jobs report, so making these near-term calculations is really difficult in real time with all of the diverging factors of everyone's saying we're going to be in a recession, inflation's terrible, but the jobs market's strong, so it's kind of hard to determine where we're going to be in the near term. That said, we are seeing some earnings estimates finally start to come down rather significantly for Q3, but still showing solid growth on top of last year's impressive growth. So nothing that would indicate a massive economic slowdown or a big recession or anything like that. So one thing, though, that is certain is that we know that the Nasdaq has really run higher off those mid-June lows. In that post-CPI release, helped to break above that 20% threshold that marks the start of a new bull run for that tech-heavy index. The run, as we touched on, has occurred as 10-year U.S. Treasury yields continue to fall from their 3.5% peaks, which they started diverging. So 10-year yields hit about 3.5% on around June 14th, and the Nasdaq started to climb off those lows around June 16th. Lower interest rates obviously tend to boost stock prices. And obviously the other factor that really determines long-term stock prices are earnings, which, as I mentioned, even though we're seeing some downward revisions for Q3, they're holding up rather well, and Q2 was pretty strong as well. So with all of this in mind, we're going to see whether or not investors, certainly if you have a longer term outlook, want to consider some of the bigger names in tech, as we've seen Wall Street prove that it's willing to start to buy some of these stocks. That said, it could be a little choppy in the near term, with Wall Street maybe likely eager in the coming weeks to lock in some of these profits off these big June lows after the brutal first half sell-off. That said, though, we did see the market climb again on Friday. I'm recording this Friday morning, and the Nasdaq was up about 1.2% the last time I looked. So armed with all this background, we're going to dive into these three stocks to maybe consider buying amid some bullishness in the market. The first stock we're going to look at today is Mastercard, which trades in the ticker MA. Mastercard is a consumer and business credit card powerhouse that operates an elaborate back-end processing network as well. The company is diversifying beyond traditional credit cards in order to become a global payments and fintech company built for our dynamic digital finance world, as people, especially in rich countries and even some more developing nations, use less and less cash. MasterCard's newer offerings include buy now, pay later, which is coming under some pressure, as well as cryptocurrency acquisitions and so yeah, just growing to be a more diversified digital payments company along with that core credit card business. So MasterCard alongside Visa are also raising their interchange fees, which is what merchants pay for accepting credit cards. So far this year, the company crushed our first quarter estimates, and it topped our Q2 projections on July 28th. The company's Q2 results topped expectations on both the top and bottom line, and the company said it saw nearly 60% increase in its cross-border transaction volume. So that's that vacation travel business, with total revenue up about 21% to $5.5 billion in the quarter. The company said that it's despite increasing inflationary pressures, they've yet to see significant impacts on overall consumer spending. And obviously, they're continuing to monitor what's going on. But as we'll get to later, credit card businesses tend to do well pretty much at all times, and we'll show that pretty soon. So Mastercard's 2021 revenue was up 23% to outpace its pre-pandemic totals by $2 billion, with its adjusted earnings up 31% last year. And despite the slowing economic growth and inflation worries and guidance from Walmart and Target and all these other companies that are showing that people are starting to cut back as inflation really cuts into their spending power. Still, despite all of that, Zacks estimates are calling for another 18% growth for MasterCard in 2022 and then 17% top line growth in 2023 to hit about $26 billion. And its adjusted earnings are expected to climb 27% this year and another 18% in 2023. MasterCard's positive bottom line revisions since its release help it grab a Zacks rank number 2 buy right now. And as I said, this is in the face of all of these economic slowdown fears. And the company has also raised its quarterly dividend by 11% in the last year. And its board authorized an additional $8 billion share repurchase program last fall. So we could look for some updates on that front in the coming months, as companies tend to do this about once a year. Meanwhile, 12 of the 16 brokerage recommendations that Zacks has are strong buys, with 2 more buys and nothing below a hold. Some investors might be a little nervous about buying the credit card stock with the possibility of a recession on the horizon, but we've kind of touched on all those reasons why it's not too worried about its outlook, even if there's a broader economic downturn. And obviously, if you have confidence in the long-term economic growth of the U.S. and beyond, MasterCard's certainly a stock to own. As we mentioned, especially as cash just continues to fall further out of favor in the global and especially U.S. economy and beyond. The stock has destroyed the market and its industry over the last 15 years. It's up about 2,500%. This is versus the benchmark's just 200% climb and its rival Visa's 1,300% run. The stock has cooled off in the past several years, with it up just about 30% in the last 3 years, versus the benchmark's roughly 50% climb. And it's down about 3% in the last 12 months to come in just above the market's 7% dip. The stock is currently trading at around $352 per share, which marks 20% upside to its current Zacks consensus price target. And the pullback also has MasterCard stock trading below its 5-year median at about 29.7 times forward 12-month earnings. And this is also 40% below its highs. So overall, MasterCard is poised to thrive in our digital money world, and it's might not be the best time to go all in on any of these stocks, considering what I mentioned at the outset, that there could be some pressure to take profits off the table amid this bullish run with all of the unknowns. But if you're a longer-term investor, you don't need to try to time things as much. So MasterCard is certainly a stock to consider both now and in the future. Next up is Adobe, which trades on the ticker ADBE. It is arguably the number one creative and design software company in the world. It went public all the way back in the mid-1980s, and it has a compelling case sort of for the best of the rest of those really blue chip tech stocks that obviously it's a well-known company that many people love and many people have an intimate relationship with their creative backgrounds, but it's not necessarily one that's up there with the Apples and the Microsofts and even the Nvidias these days. So overall, Adobe is starting to reach levels that should attract long-term investors if you're considering it as a buy and hold over the next several years or more. And the company already reported its its earnings and guidance in mid-June. So analysts have had a chance to look over that report and see everything that's going on in the near term as it faces headwinds like everybody else. They did guide a little lower at the time, but there was nothing alarmingly low. So let's break down kind of what the company does first, and then we'll dive into some more of what's coming next and some other fundamentals. So for those of you who don't know, Adobe's portfolio is full of subscription-based software that includes Photoshop, Premiere, InDesign, Illustrator, and many others, over 25 unique software offerings. The company's products help users edit videos, images, create artwork, books, really anything else you can imagine creating or designing on a computer, tablet, or smartphone. And I like to say that its Premiere software is so big and important in the whole broader ecosystem that it's used as one of the Hollywood standards for editing movies and then also making student films. So that's how important it is, and that's how wide-reaching it is. The company's creative cloud business is doing insanely well. That's that $55 a month service that offers you all of their packages in a big bundle, whereas then you can pay for everything else in smaller individual packages. And these are monthly or yearly subscriptions that people really can't stop once they start, because their business or whatever they're doing relies heavily on that. On top of that creative portfolio, the company also has a documents business, PDFs, e-signatures, marketing, commerce, and more. Digital workflow is something they're working on as well. So with this in mind, its sales climbed 23% to $16 billion in 2021 to extend its streak of 15% or higher revenue growth to 7 straight years. And if you look on a chart, you can see that they changed to a subscription model around 2012. And that's when you can see their sales kind of start to take off and really consistently grow at double-digit clips. So as I mentioned, the company topped our Q2 earnings and revenue estimates, with its adjusted earnings up 11% on 14% higher revenue. So despite that beat in growth, the stock did drop after the release on slightly lower than projected guidance. Management also said that the strong US dollar is impacting its business, along with some other near-term headwinds, which are kind of across all tech companies and the broader economy. That said, even with the new guidance, Adobe's revenue is projected to climb 12% in 2022 and then another 14% in 2023 to hit over $20 billion for the first time. And its adjusted earnings are projected to climb another 8.3% in 2022 and 16% in 2023. And this is on top of what was 24% growth last year. And then in terms of its price performance, the stock is down, about 42% from its November peaks of nearly $700. It's currently trading at around $440 per share. And this is total speculation, but this is maybe a company that could be a candidate for a stock split, as you've seen all these other big tech names from Tesla to Apple to Shopify split their stocks, and even Alphabet. Adobe is now trading around where it was in June of 2020. And despite all that downturn, the stock is still up about 1,200% in the past decade to blow away the tech sector's 220% climb. The company has also been a part of this big upward climb from mid-June. So the stock has ripped above its 50-day moving average, but it's still trading below its 200-day. And overall, it's just a good rule of thumb. If think about all the people that were super bullish to be buying the stock back in November at near its highs of around $700, who now are considering why would they buy it now at these what appear to be discounted levels at $440 per share. And then in terms of its actual valuation, the stock's trading at around 35.3 times forward earnings, which is still a bit pricey for some people, but it's actually its lowest levels since it started that subscription model, where it changed kind of its whole trajectory and what Wall Street was willing to pay for it. So it's really the lowest levels it's been in about the past 8 or 9 years, and even below its COVID low. So certainly worth considering it on the valuation front alone. Adobe lands its action number 3 hold at the moment, and 18 of the 22 brokerage recommendations that Zacks has are strong buys, with nothing below a hold. So certainly worth considering at the moment and as a longer term play as well. And we're going to close out with a massive company that's one of the biggest holdings in many tech focused ETFs, and that is Microsoft. Trades on the ticker MSFT. It's a technology titan that kind of similar lines with Adobe. Once it went to a subscription software business, it changed a lot. And then its cloud computing business has really completely changed its entire outlook for the near term and the future. So the company, like everybody else in this tech sector, has tumbled from its November peaks, but it's held up better than many others for obvious reasons. The company did provide some downbeat guidance in June, but we saw it report already. So it reported on July 26th, and that was its Q4 FY 2022 results. The firm did report its first bottom line miss in over 5 years, but it only missed by about 2% on the bottom line. And it did provide slightly downbeat guidance, but once again, nothing crazy with its 2023. So it's FY 2023 total consensus estimates only down around 4% from where it was 60 days ago, with 2024 only down around 3%. So nothing major despite all of these broader economic slowdown fears. And a lot of this is also due to a strong dollar as well. So looking ahead, its overall outlook remains really stellar. So Zacks estimates call for its revenue to climb another 11% in FY 2023 and 14% higher in 2024 to hit $250 billion. And this would be up from $198 billion in 2022, so the year it just completed. So adding another $50 billion to the top line over the next 2 years. And this, as it would extend just years, it's done 5 years in a row of double-digit top-line growth, and it's set to do now what would be 7 years in a row in 2023 and 2024. Meanwhile, its adjusted earnings are projected to climb 10% this year and then another 15% in 2024 on top of 17% growth on the bottom line last year. And then driving this expansion is obviously its cloud computing business and its sweeping software offerings for businesses, universities, individuals, and beyond. And I mean, just consider kind of the growth on both the top and bottom line for a company of its size and age. It really just shows how important all of the company's offerings are, and certainly that high margin cloud computing business that's just going to continue to proliferate. And obviously, on top of cloud computing, you have Office and all of those Windows offerings and Zoom competitors and its Xbox unit, LinkedIn, and it's really just a money printing machine as well. So it closed its most recent year with $105 billion in cash and equivalents. So it can continue to roll out new purchases, both big and small, with plans on the bigger side as well that it's in the midst of. And the firm also returned about $12 billion to shareholders via buybacks and dividends last quarter, up about 20% from the year ago period. And we should note last year, so last September, it raised its dividend by 11%, and it's likely set for a raise when it'll announce that in the next period as well. That's speculation, but that just seems likely at this point, given its impressive cash holdings and its balance sheet and all the cash. It'll probably do that next quarter. And then given this backdrop, Wall Street's really still high in the stock, kind of for no-brainer reasons. 22 of the 24 brokerage recommendations Zacks has are strong buys, with another buy and one hold. So overall, its shares are up 300% in the last 5 years. This easily tops the tech sector's 87% run, and it's now only down about 2% in the past 12 months with that big climb off those mid-June lows. Friday morning, the stock was trading at around $290 per share, which offers about 16% upside to its current Zacks consensus price target, which is great. And then overall, it's a Zacks ranking number 3 hold at the moment, and it's trading around 22% below its highs in terms of valuation. So it's trading at 27.8 times forward earnings at the moment. And obviously, it's nothing crazy earth-shattering to say that Microsoft's a great long-term play, but all three of the stocks we talked about today, you could consider buying them both in the near term and the longer term. And even if there's more pressure to sell in the coming weeks and months amid economic slowdown fears and what the Fed's going to do, you don't need to time these things exactly. And all three of these stocks are going to be posting solid double-digit growth in both the top and bottom lines for years to come, just because they operate such stable businesses that aren't going out of style anytime soon. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.